Okay, hi guys, welcome back again. This is part 3 of market structure lessons. Ne? So, today we are going to be speaking about something very crucial and important, and how you can avoid falling for a fake structure break, or rather, whereby price will do a stop run and then you will not know if price have done a stop run or not. So, basically, this lesson is about how to avoid fake structure breaks, ne? How to avoid fake structure breaks, yabo. Because usually I know you've experienced it, ne? I know at some point in time you've come across something. By the way, my name is Bfxtpro. HAMBANAMI is our concept that we are trading. Very nice concept. So yeah, hope you please don't forget to subscribe to the YouTube channel and click a like on the video. Don't forget to like. So yeah, let's say for example this is this is the market, it's going up. Obviously a market that is going up like this is a market that is creating higher highs, ne? So the market structurally it will move like this, ne? So one thing you need to understand is that at some point in time a market is not just a straight line that just goes up, ne? It has to balance and rebalance, ne? It has to create some sort of imbalance and then rebalance again, imbalance and then rebalance again, ne? So obviously, so when it's going up it won't just go straight up, because there's two sides in the market. We have both buyers and sellers. Even in an appreciating asset or markets, or a stock that is always bullish or that has been appreciating for years, like USDT or Nasdaq and all that, even in such pairs we still have people who are interested in shorting that pair, or rather selling that pair. Yeah, so how do you now avoid being falling for the trap, né? So understanding a market structure is something like this. Okay, so if I am to understand the market structure, or what it is said is that, okay, so the market will create an imbalance, né? So when it creates that imbalance, we need to understand, when it creates that imbalance, we need to be able to identify or clarify what exactly is it doing. So when it creates an imbalance, it's moving impulsively. What does that mean? It means that orders are released. Yabo? Orders are released, and then some of the orders that were released, né, or maybe let's say institutions bought, yabo, then orders are released, the market moves impulsively to the outside, to the upside. How do you see that, né? You will see that with these big thin candles, whereby you'd see this market is moving up but it's not retracing. There's no down candle whatsoever. The market has just been moving up, ne? Then at some point in time you'll see it will start to do this came back to where it began and then continue up, ne? So obviously one would understand what's around here would have our demand zone, or would have an order block, ne? Either way that we are going to have around this area, that's what we are going to have. Then what will it do? It will break this higher high, ne? The high that it first, for you to confirm that we are still bullish, price has to break this higher high. So that's why we say in market ends and goes and creates higher highs, higher highs and lower higher lows, ne? So this will be your higher low right here that has been created, higher low. So that's how you understand structure. That's how you can structure a market yourself and be able to develop a strategy for yourself. Yeah, so now you say break here, and then now it has created a new high. The fact that it has created a new high and broke the previous one, that alone gives you an indication or direction, or a clue that, okay, high chances are we are still in an uptrend. So I should have my focus on the uptrend. Yeah, don't fall for the mistake of trying to sell in a market that is uptrending. So your job as a trader is to stick to the current trend as much as possible. It's very important for you to stick to the current trend. So now you can see the market is uptrending. Then what it will do is it will retrace again to a point of an imbalance, and then move up again, create a new high, and then it will just start again, retrace again. Then sometimes you'll know it won't retrace all the way to the point of origin, but it will go, it will retrace maybe to a previous high. But sometimes it will just test this previous high and just move and leave this space right here. yabo, and move, yabo. So now how do you avoid the fake structure breaks that happened, ne? So for you to avoid such, there's something that I wrote here: external swings and internal swings. You need to identify the difference between the two. An external swing is basically the longer structure, or the long-term structure that is happening, and then an internal structure is the one that is happening in an intraday basis, or rather day-to-day basis. That's why that's where you'd identify an internal structure. Yeah, so in this case now, obviously, let's say now market here ends a let's say boom, it breaks a structure. So the moment it does this, and we all know it's okay when price breaks something like this after it has created a higher high. You can see there we have a new higher high. So the moment it does this, most cases one would say, okay, we are now in a downtrend. Only for price to do what, okay, someone will change, then they will assume that this is charge, of which it is in most cases, but you'd find that even if this is charge, price will still go to the opposite direction. You'd find that price, after even breaking the structure, you'd find it was just coming here. It was just coming here to do this. So now how do you avoid this? You avoid such by identifying the main swing points. This is a price swing. So for as long as price isn't broken a major swing, it needs to break a major swing for you to understand this is a major swing. Even if it breaks this major swing, could be going for the next major swing. Let's say yes, you were right, it does break a structure, and our problem is that we sometimes everyone, I think, has this problem whereby you'd identify the downtrend. Let's say you sell there nicely, it breaks again the swing, then it retraces back up again, then you continue to sell. Then you get obsessed with the downtrend and forget which initially we are still in a downtrend. For as long as we haven't broken this structure here, this is our main swing. You need to be able to identify this price swing. Then you will know it's okay, so it's going for the next part of liquidity. If we have a liquidity void here, you will know. If we have a fair value gap here, you will know. And then you have an untested order block here that price will want to test. So even here, let's say you have equal lows maybe that were between here, you'll know it's okay, so price is coming here to form some sort of a taro soup pattern. So that's how you can be able to do what? To identify fake market structure break without falling trap of them. Let's say now the market is downtrending. Here it is downtrend. Let's say it moves impulsively, then it retraces, but then doesn't retrace all the way up. It retraces, it comes again, then retraces again, respects an order block, comes again, retraces, respects an order block, and then gets to this area. Then you see, so you need to also identify the big major structures, and so you will see how it forms. You see how it was forming these structures from this high to this low, to this high, to this lower high, to this lower low, to this lower high, to this lower low, to this lower high. And then now you'll see it will start making what? Small structures. You see, these in most cases is what we would call some form of an exhaustion, which okay, this market is now a bit tired. So and then at some point it's where you are mostly likely to see a structure break like this. You'll see a structure break like this, and then the market will come back. That's your charge there, obviously, and then obviously now you are looking to be buying. A lot of you will want to buy all the way throughout, and that's where you make the mistake. You need to wait for price to fully trade above this, and then you need to understand what's above here. What's above here? What is it that I can find above here? Then above here, if you have an untested order block and all that, you will know it's okay. My major swing starts here. This is my swing point. This is a major swing. You need to be able to clearly identify your major swings. This is my major swing. So I understand it's okay. So as price is retracing and it broke a structure here, that does not mean the price will go now all the way up. It means that since price broke here and started to create these mini structures, you can see these mini structures, You can see here we have a nice, you can see a reversal pattern. Even if we put our trend line, you can see it's a reversal pattern, confirms very nicely. But now what happens is when price gets here, where now you'll still be obsessed with the trend and forget to now we just completed a swing and I made an area of a major swing. So around this area I should anticipate either continuation to the downtrend, then price continuing. So this is how you can avoid fake market structure breaks. You need to be able to understand what if here I have a major swing high, this is my major swing high, and then below here I have my what, my major swing low, major swing low. Here's your major swing low. Yeah, but your major swing low is this one. This one you can't put it as a major swing. Also this one, these are what we call the internal structures. You can't say, because the last time we created a boss, or rather break of structure, BOS, was here, ne? This was here, and then these ones were just internal. So meaning that when the overall part that you are looking at is this one here, that's what you are looking at. You are looking at this overall, the major swing. Price will still be doing that, but the problem is we fall traps of the internal structures and think that price has broken structure when clearly it hasn't. That's our problem in most cases. We would fall for that. So these are opportunities, all of this. This is an opportunity, a buy opportunity that you can catch for as long as you know where to exit. If you entered here, you know you want to exit here or corner la. Then when you get here, you know it's either you wait for a confirmation for price to confirm that it's now going down, and then you continue to ride the trend. It is very, very important for you to ride or to be trading the major trend, ne? So I'm looking at GBPUSD right now, ne? I want us to see here how easily it was for one to not see the major and internal structures. Obviously here one can easily identify this as a swing high, right? Then one can easily identify this as a swing low, ne? So obviously this high is the one that made this low, and this low is the one that made this high, and this high is the one that made this low right here. That's a major swing. Then anything inside here is not major. That's why most cases you see one will see this trend now uptrending, and then will be obsessed with trying to buy this market all the way up, and forget to see this was just this price swing alone. It was a price swing on its own. So a price swing is in HAMBANAMI we have what we call a point of origin, where the price began, ne? I won't explain that here because yeah, only the students will, the mentorship students are the one who understands how we identify that, ne? But it's our way of identifying liquidity. You can see how price here was coming down, then here, or if you want to understand where did we have our structure break, you need to be able to identify the lowest low, which is this one, ne? This was the lowest low that was created. Which high created this low? It's this one here. Was that high broken? Yes. So George happened here. This is where structure break happened. A lot of people will catch the market say like then structure break happens corner la inside whilst you are watching, and you'd watch it happen without seeing what is happening. As long as you are able to identify where the swing high, where the swing low happened. So the moment price did this, broke this, that was a break of structure, right? Then it comes with another clue. Boom, it fails, ne? For as long as it fails to take out this low, you are still you can still look at the upside, you see, and then it comes up again, comes down again for more liquidity below these lows, comes down for more liquidity. There's a liquidity pool there, comes across it, and then moves impulsively. Now you already understand now when this footprint or this big move has happened already. Now you have a clue as to what is likely to happen. We can push to the upside. So now you need to identify the major swing high that initially created this low. The one that created this low is the one that you want to focus on. So in this case, It's this one here. So you need to identify other factors also, your liquidity voids, your fair value gap, your imbalances, and all these things. Yeah, but initially you can see how price comes back to this area of price again. It comes back to the point of origin where everything began. Yeah, then it moves and moves and moves nicely, and then from there we continue with our selling. Most people will want to do this after price has done this. They will forget about this upper part. Some will try and say, okay, this is an untested order block, and try to sell here. Yes, you can try to sell here, but now up until where? You see, if you sold here, you are out, kicked out. Yeah, so another way of now, here's another one footing, what we fail to understand. Also here, are you able to identify the major swing here? Yes, if you are, here it is. This is a major swing. Ne? We just created this major swing low. Then we moved impulsively to the upside. Yeah, and then what do? We create this internal low. This is internal structure. We create this internal structure. And then what do we have below here? Another block. Here's our order block right here that has not been tested. Then what do we have also? We create an footy, another new low again, ne? Internal low, but above you can see we create another higher low, then we create a higher high. Then all of a sudden price moves impulsively. This is where people felt trap munch. This is what is called inducement in ICT. Ne? This is what we call inducement. This is where most people fail for the traps, or fail to understand in markets. Well, this already is liquidity on its own. This is a gap. This is an untested OB. That's why now when price comes down here, it does not even begin to close below, but when it gets here, you see it just comes straight to the order block. It just comes straight to the order block and respects it to the pip and then moves. Shows what it encountered a pool of liquidity, some of the liquidities that were not tested. These impulsive movement, these thin candles indicate that there was smart money buying around here. Institutions were starting to do what? To buy around this area. So now when it starts to retrace like this is not a structure break. Because a lot of you, I know what they will do after price reacts here. After price is broken this low, a lot of you will want to do what now? They will want to sell here. They want to sell at this other block right here. They want to sell here. And selling here is not a problem. Not that there's no liquidity here. There is liquidity here. And that liquidity is consumed too. You just need to understand how. Yeah, well, even here, one would think, this is a structure break. It's not, because the major swing for that is 9 major swing. Yeah. So when price breaks this, it's not a fake structure break. It's not a full market structure break. So for you to be able to avoid falling trap of the fake swings or of the fake structure breaks and all that, you need to clearly be able to identify your major swing points. You need to be able to differentiate between a major swing and an internal swing. Internal structure versus external market structure. You need to be able to identify that. You see one after this right here, after this break, you see how after we tested above there, we come here and then we break below here. Then after breaking below, we break, now we structure again. You can see we have this swing low right here, you can see, and then we break it. But now one would forget to go to nice swing is CNZ. This major swing or this major movement was made by this swing here. That's a major swing. That's why price after that decides to fall. So one will do that. How would they fall for it? One will say, okay, we have broken structure here. I will now look for buys. Then when market gets here, a person will look for a buy. Then boom, they lose in the market, and then they'll be like, now you're gonna start crying and say, market's this, market's that. And all you have to do, you need to be able to structure your trading and understand the type of trader that you are. Understand yourself too. Understand what you react to emotionally. Once you understand what you react to emotionally, you will know the things that affect your trading. Because the main barrier, or one of the things that block us to our trading success, is nothing but us. It's ourselves. We are the ones who are doing that. It's our minds. That's why it's easy for you to grow a That's why it's easy for you to grow a demo account easily, but when it comes to a live account, now you start to teka seyanyiwa manje seziyakhala. Why? Because you have attached yourself, or you've attached yourself to that money. Number one, you have this fear of losing. You don't want to lose that money. Already that your thoughts are affected. Already your psychology is affected, because you have this would say, okay, if I lose here, what happens, and all that. Yeah, well, those are the things that we need to avoid psychologically. You need to be able to trade without being emotional. Once you remove your emotions. So how does that start? It starts with you by finding money that you are willing to lose. The moment you find what money you are willing to lose, you become attached to emotions. It means that when you see an opportunity, you will not fear because you would lose. You will take calculated risk. You don't just take a trade in just because you want to take a trade. You'll calculate it. Oh, okay, so if I am to take a sell here or a buy here, it means that I'm going to lose this much. The moment you accept that loss, or accept it, I'm willing to lose this much, your profitability begins, because you have catered for that loss, or you did say it's okay, this loss I'm willing to lose maybe up until this much, and I'm done. Yeah, but if you lose that much, you need to know it's okay. Maybe the setup didn't fail. Obviously, nothing is 100% in the forex market. Yeah, but even if your strategy is that much, it can be just 80% to, yeah, but 20% of the time, 15% of the time, your strategies will fail. Not that your strategies on its own will fail. Maybe you will see something that you cannot see, because the market won't move the same. But when I be able to identify a market structure, because that's the main key point. Once you understand the market structure, you're almost half done. Like you're halfway there. Once you understand how the market moves, doesn't matter what you use to trade or what you use for your confirmation. But once you understand a market structure, once you understand that, you're gone. So yeah, guys, let's be able to identify that, and then please let's be able to identify that, and please don't forget to press the like button if you like this video, so that I can be motivated to share more of my knowledge with the industry. Don't forget to subscribe, don't forget to view. If needed be, you can even share the link to your groups, because people once linked my course. So yeah, sure, you'll find it somewhere, somehow, even on YouTube. So people once linked my course and all that in groups and all that. The same way they did that, now where you can be able to share the link to groups, so that you share the knowledge. But there's more that I'm going to share. I just wanted to share that piece of how you can avoid. Obviously there's more, I'm not gonna share everything, of how you can avoid falling trap of fake market structure break. Is at this point, or at this moment, even before now, we all understand the market structure breaks. Let's understand with the market my so it break a structure. When it did this, it broke a structure. But now there are times whereby you will encounter something like this. Let me move this here and bring it here. You will encounter something like this. It happens in most cases. Let's say you'd encounter something like this. Boom. Encounter something like this. You see here, we were going up, and then all of a sudden we went down. And then you will think that now I'm going to sell at this other block here. Then what does the market do? The market continues to the upside. So those are the things that I'm trying to make you avoid. We still gonna have another lesson, just ensure this lesson pushes and it also, don't forget to like. If you've viewed this and you've liked that, don't forget to like. You see, and then the market does this, then one will be confused as to what happens. There's so many ways to avoid that. All you have to do is to study those moves and check those moves, and ensure you do not fall trapped of them. And another thing I want to share before I close, please don't try to be everywhere. That's one thing that kills most traders. Don't try to be everywhere. Right now you are trading GBPUSD around 10. Now you are trading Euro USD. Now you are trading USD JPY. Now you are trading Nasdaq. let's do specialization. Let's do what we call specialization. Know how to specialize. At least focus on 1 or 3 pairs, maximum 5, that you know it's okay. If maybe I don't get an opportunity here, I'll get it here. If I don't get an opportunity here, I'll get it here. So yeah guys, please don't forget to subscribe, and don't forget to press the like button. You can also go to the previous videos and watch them to see how did we get to part 3. Hope you're enjoying this content. Thank you. My name is Bfxtpro, HAMBANAMI. Yeah, you can check Bfxtpro also on TikTok. You can check Bfxtpro on Instagram, yeah, and Facebook. Yeah, Instagram and Facebook. Yeah, but there's a lot of fake accounts of Bfxtpro, people trying to make themselves Bfxtpro whilst they are not. Yeah, well, so there's a link that I put on the Telegram group that will direct you straight to my free Telegram channel, where I have a simplified course of ICT that you can check out if you want to. So when I just go to the check on the description, and then you'll find a link there that will direct you straight to the Telegram. Thank you.